Right, last class we're talking about the different types of ways to calculate bars. So parametrics, what you did on the exam, and it's what you're going to do on the second exam too. But we'll probably have some historical, maybe stochastic, it depends. I kind of mix them together. You'll see we're going to work some examples tonight of the more difficult type. So historical and statistic are essentially simulation. It's just that with stochastic, you're creating simulations using some kind of model. And then with historical, your simulation is just whatever historical period you pick. So most of your banks are using a historical VAR. That's why their VAR jumps so much whenever the market jumps a bunch, because they're just using rolling history, which I've never thought was the best way. In my opinion, that means you're grossly understating your risk during calm times, and you're grossly overstating your risk during risky times. I'd like to be just the opposite. During calm times, I'd like to assume risk is higher, and during risky times, I like to assume, hey, it's, I'm kind of a reversion to the mean risk person. So, and what do you do? How do you find your simulation? Well, how do you find where your VAR is? You just rank all of your losses in order. And then if your risk tolerance is 0.2%, then you want the 0.2% from the lowest. So if you have 10,000 simulations and you have a 0.2, then you want the 20th worst, which would be what, 99,981. So that's how it was at USA. We just listed all of our catastrophes, all of our earthquakes, hurricanes in order, and our risk tolerance 0.2%. We just went and found that particular one. It wasn't our worst case. Your worst case isn't in your simulations. Your lowest simulation is not your worst case. There's something worse than that. But the worst case is the sun blows up and becomes a supernova, right? That destroys everything. That's not in our scenario. We hope the astronomers are right, and that's a rare event. Our meteorite hits the Earth or whatever. There's a worst case. So we're talking the 20th of this particular distribution, which excludes even worse things. If your stochastic, historical, and parametric are inconsistent, they certainly can be, and you're going to see that on the exam too. It's probably because of the symmetrical assumption in parametric, because you're using a normal curve. So if there's any skewing, the parametrics going to distort that. You're going to see that in your project as well. You're going to compare parametric to historical, and a lot of times you're going to find very different answers, because the parametric not only does it assume normal, but it also is using current assumptions going forward. When you're using historical, you may find very different answers, because bonds have done extremely well the last 30 years because rates have been falling. Stocks have done really, really well. International stocks have done horribly. The historical data looks very different than the assumptions that assume international stocks will do better, that bonds are going to have a much lower return going forward. So you can get very, very different answers. I don't know which one's right and which one's wrong. It's unlikely bonds going to make these double-digit returns again, starting at such a low yield. So there's probably some advantage to the parametric. We'll come back to talk about the project here a little bit later. There's one other thing we're supposed to come back to, but I don't remember what it was. Oh, the more complex. Before we do that, I want to talk options. So we're going to work some of these problems, but just real quickly on the options, what could you do? William, you're talking about straddles and strangles and condors and all those kind of things. I'm going to show you some real simple option strategies that you could at least think about. There are some pretty good papers out there that there are option strategies that really do beat the traditional approaches, and you have to read those and see if they're true. What you'll find is they do tend to beat, but there are periods of time where they're really, really horrible. So nothing's like perfect all the time. So you have to kind of see when don't they work? When are they pretty bad? And most of them don't work in the 90s when everything just goes up for 10 years. When everything just goes up for 10 years, you just buy stocks and bonds, and the world's really simple. So these strategies tend to work better in very volatile times. So let's just assume your grandparents are retiring, and here's their portfolio. Let's say it's $1 million. If the stock market goes up, it stays $100,000. Stock market goes up, they make 60,000. If it falls, they lose 60,000. Say, well, that's too risky. Let's put some bonds in it. So what does adding bonds do? It's just going to shift that shift the angle. You're not going to make as much return, but you cut off some of the downside. But that's assuming stocks and bonds are uncorrelated. But it does reduce some of your risk, because even if they both fall at the same time, you know, or maybe they're assuming they're more correlated. So here's some strategies I've used in the past. We'll talk about one of these. One is just a put. I don't have an actual put strategy in here. So this is a collar strategy. What this strategy does is it buys puts on the bottom so that you have a max loss. You can't lose any more than that. That's your insurance. But you pay for it by selling call options. That cuts off some of your upside. So you keep this from being so expensive by selling call options. By selling call options, you cut off some of your return. All right. This one here, what is this one here? That looks too good to be true, doesn't it? You make money when the market crashes and you do pretty well when the market goes up. That's the strategy I was talking about. When options are really, really cheap, you overhedge. Because it's so cheap, it doesn't cost you all that much. So you keep the same budget as you would here, but you just overspend on the puts. And that way, when the market crashes, you actually make money. So that one's very limited. That's when I talk about when the VIX gets below 10, that's when you just go a little wild on the insurance and just buy extra insurance. Does that happen often? You know, we did this in the investment society when the Tokyo earthquake hit, and we actually went up 11% when the market went down 11%. So you can do it. That was a time when the VIX just got really, really low, and I say, hey, I'm going for it. And we did it with the student portfolio and say, hey, let's do it. And yeah, it's kind of fun. It's really fun to make 11% when the market's down. So anyway, you can see them individually. This is a collar strategy. So you do this at UTSA. I don't like this strategy. So when we were talking about gamma, this strategy has a horrible gamma. What gamma tells you is how does your delta change as markets move? Your delta is how much you move versus the underlying. If your delta is really high, that means, hey, if the market goes up 10%, you go up 10% or whatever. You know, if your delta is, you know, 1 for 1. Well, this one has a delta 1 for 1 right here, but the gamma is telling you, boy, this, as the market goes up, at some point you're really going to regret it. I don't like this strategy. We did it some at UTSA, and I just stopped doing it. One thing I'll tell you, if you do this kind of strategy, if the market falls, and I did this throughout my career at UTSA, if the market falls and you can buy this back cheap, buy it back cheap. So my thought was, anytime the calls fall 90%, I'm going to buy them back. I'm just going to take that collar, the top of that off. And so, yeah, if it falls 90%, so once it hit 90%, and there was one time in 2009 that really saved us, because the market crashed, our calls just went almost nothing. We bought them back and the market shot right back up. Our option traders thought we were geniuses, and I was like, no, we're not geniuses. We're just really, really lucky. But no, I told them we're geniuses, but we were really, really lucky on that one. They told me they were going to start just emulating all our trades, but that was a really lucky trade. And then you put them all together. So are these the best strategies? I don't know. If you look at some of these straddle strategies where you do some spreads and you try to find different combinations, there's probably a much better strategy out there. The problem is there's so many choices. You know, there's just so many different things you can put together. I think there's something here. I wish people do more research, not for the average investor, but for the 70-year-old investor that's just cannot take that downside. I just have to believe there's a much better strategy than the traditional 60% bonds, 40% stocks, or whatever. I think there's something much better out there with the option market. The biggest problem with the option market is that as the VIX rises and falls, these strategies get more and less expensive. So it becomes something that it might work in 1 year and not work in the next year, just because the pricing gets so bad, and then you got to kind of reassess it. So it is a little frustrating from that standpoint. Yeah, so I'll put them all together. Let me show you another strategy here. I haven't updated this today, but so it's a little bit old. Let's say you have $1 million portfolio, and I'm going to do one of that strategy. This is, boy, I should have just done this strategy, but this is the strategy that does that, but then tracks the market fairly decently. So this is a strategy I really recommend for your grandparents. So You have $1 million. It costs you $2 to execute. My goal was to get this essentially free insurance. Everybody likes free insurance, right? How much free insurance would you take if someone gives you free insurance? So, okay, if you die, I'll give you whatever you want. It's free. Yeah, make it $1 trillion. Why not? My family would be really happy about it. Well, I mean, maybe not. You don't want your family happy if you die. But, all right. So let's say the stock market rises 50%. You'll make 35%. All right, that sounds horrible, but I'm not comparing this to the stock market. I'm talking about a 60, 70-year-old person who's, 40% stocks, 60% bonds, something like that, all right? If someone who's 40% bonds and 60% stocks instead does this and the stock market is up 50% and they make 35%, they're going to do a lot better, right? If they'd been in bonds, they would have made about 30%. So they're better off. What if the market falls 60%? Well, then they're down 11%. If they've been in bonds and stocks, they've been down 35%. Which would you rather your grandparents do? Sounds pretty good, right? What's your one big disaster? The market doesn't move. This is when your grandparents are really mad at you. How often does the stock market make 0%? We can look back historically. There's one right there, 1994. I remember 1994. That was that horrible bond market. The stock market actually finished positive, but the bond market, remember that's when Greenspan woke up one morning and said inflation's a problem, and he raised rates really fast. So 116 probably wouldn't have done that well. Would have been down 3% when your other portfolio had been up 1%. That would have been pretty painful. So there's 1 year you would have been pretty disappointed. -9, you probably would have been disappointed in that one. I got too many files open here. Yeah, that would have been painful. There's 2 years. There's another year. There's another year. There's another year. So yeah, you're gonna have some times where this strategy is gonna definitely not do well. But if I can find you a strategy that always does as well or better, that would be wonderful. That doesn't exist. You want the strategy that's up 10% every single year. Unless the market's up 20%, then it's up 25%. I don't have that strategy. It doesn't exist. So if the market's down, what if the market's down 99.9999%? You're down 11%. Now, if the market falls that much, the world will probably come to an end. So the option market's probably going to be bankrupt too. So that probably won't happen. But what's the point here? The most you can lose in this strategy is 11.8%. I think that's a tremendous thing to tell a 70-year-old who's living off their portfolio for the rest of their life. But you do have to warn them on the zeros that they're going to lose money in a year when the market wasn't down. That's kind of bad. Now, I kind of, the 116 one looked bad, but remember the bond market was down what, 2% or something. So they would have still lost money because the bond market was down. So in that case, I'm assuming here the bond market's always up 2%. That may not be the case. So there's other scenarios. I'm not saying this is the right solution. I just think this is an intriguing solution. And so, think about it. What I really argue is look at what the option market is offering. And if this is the better strategy, go for it. You can set these in for a year in advance. This is what this is set up 1 year in advance. So you can tell your grandfather, hey, no matter what the market does, the most you're going to lose is 11%. You cannot tell them that on this one because you don't know what the bond market's going to do. The bond market might be up when the market's down, but it might be down when the market's down. You can't tell. There is no max, and you don't know how much the stock market will be down. I guess you can tell him the worst case is he'll lose 100%, right? Stock market's down 100%, bond market's down 100%. So you can tell him it's down 100%. On the options, you can say as long as the option market is solvent, the most you can lose is 11. And you know this mathematically. This isn't an unknown. For an absolute fact that's what you have. Now, if you decide to roll this forward or do something halfway through the year, yeah, that 1196 changes. But as long as this is in place, that's the most you can lose. You can gamble on that. So y'all need to go out and find a better strategy. I've always thought I'd do it, but I've never had the energy to sit down and look at every single possible combination. You start talking about not just combinations of calls and puts, but maturities, spreads, you got there's so many combinations on who knows what's going to happen.
So in this one, you're just buying the call and the put.
I'm buying the put and selling some calls
to
keep the price down. This one would not work today because the VIX is so high today. So this one worked back when the VIX was more normal levels. And if VIX is really, really low, I probably wouldn't sell the calls at all. I'd probably just buy the puts because it'd be so cheap, so it changes. The thing I like about this though is you can use the 1 year leaps, the 1 year, you can set them in for a year and you can just let it go. Or sometime around, 7-8 months in, you might roll it forward and see, so whenever you do option strategies, you never just set it and let it go. You always have to monitor it. So it's a little bit more active than you might have in other scenarios. All right, so does this work? So just a little bit of USA. This is my boss, former boss. Anybody know Joe Robles? It's you should have seen the day he retired. I don't know if y'all have seen that video. He was walking down USA's hallways, high-fiving. He was like the most beloved CEO. His predecessor wasn't quite as beloved, but he was, boy, very, very beloved CEO. But here's his annual report from the year I retired. Last year, we grew associations assets to 68 billion. Our net worth improved by $200 million. Thank goodness we hedged our pension plan. You remember it was up how much? It was up $600 million. Every other pension plan was what? Down hundreds of millions of dollars. That one decision kept our net worth. I think USAA and MetLife are the only two financial companies whose net worth actually increased in 2008. So that was good. One decision did that. In a year when most financial services companies posted record losses and the S&P dropped 37%, USA earned $420 million in net income and generated positive investment income. In fact, this is my department right here. USA's property and casualty equity portfolio returned a positive 1% last year. How did you do that? It's option strategies. They do work. They can provide a lot of protection. Now, what we did is we had options in place, and in November, we were down 9%. And so we decided, the market was down much more than that. It was down like 50%. So we decided, hey, let's take the options off. And boy, my boss got scared to death. What are we gonna do that? So we went and met with Joe. Said, Joe, I want to take the options off. And he said, yeah, go ahead. In the stock market, you lose money. So, okay, thanks, Joe. It's like a really short meeting. He was fine with it. Now, this is a CEO. This was his first year as CEO. All right. He just took over a CEO who hated stocks and had a zero in the stocks. And now he's got this crazy guy, Ron, who's putting him back in the stock market. And a year when the stock market's falling 35%. And he said, yeah, if you buy stocks, you lose money. Pretty courageous thing for him to say. You would think he would have just been frantic, but no, he's fine. He looked pretty much like he did in his picture, very, very relaxed. So part of my thought process, you might really strongly disagree with this, but part of my thought process for the options was, I've got a new CEO taking over a previous CEO that was very kind of micromanaging, very risk focused. This is his first year. If I put us back in stocks and it crashes, it's going to make him look really, really bad. So I decided to really be careful. Does that make sense that I make decisions because you have a new CEO? I thought, it's from USA morale and all that other stuff. Yeah, this is a year to kind of tread in lightly. Don't let's jump into the stock market heavily. And then, so you can imagine we jump back in the stock market, the previous CEO leaves and we're down, hundreds of millions of dollars. And in a bad year, like it just makes him look like he doesn't know what he's doing. But then he showed this chart. It's my favorite chart. Kind of a ridiculous chart, yeah, but just to make. Now the problem with this chart is then all our members are saying, but my stock mutual fund didn't do that. It's like, well, yeah, because we couldn't do options in your stock mutual fund. So sorry, we couldn't do that. So you can have a big impact in your companies if you're thinking about risk and how to kind of offlay risk. All right. So let's try some problems here. The the first time kind of watch, and then the second problem, try to do the math. So you kind of see where we're going with this problem. I love these problems because they're really, really real life. This is stuff we actually did in practice, so it's real life. So let's start with this first one. And I'll give you some more. In fact, we'll work the one from last year's exam. I'm kind of running out of ideas, creative ideas to change up the problem every time. So if I keep giving y'all every exam question, I'm gonna I don't know how else to trick y'all and the plug in the wrong number somewhere. So you got $1 billion portfolio. Sometimes I say you got a portfolio that has $1 billion notional amount. That doesn't matter. If it's notional or real, it doesn't matter. It's the same amount. So the $1 billion tells you what your market exposure is. All right. It has a VAR of over 100 million. We're actually going to calculate that. So that we'll see if that's true or not. That's one way you can test yourself, because you're actually going to calculate that number. If you get 87, you probably did something wrong. I mean, maybe I did something wrong, but you probably did something wrong. Risk tolerance is 0.3%. Your boss has expressed a desire to reduce the VAR below 70 million. I don't know where that came from, but why 70? Why not 62? Why not 83? But that's what they had, while maintaining or improving expected return. All right, so that's not a difficult task. I want to keep our return the same or higher, but reduce the risk. But they do that all the time with hedge funds. And we'll talk about when we get to the end of this how reliable that is. You are considering adding one of the strategies below, A or B. You will allocate either 10% or 20%. So 90% current, 10% A, 80% current, 20% A. I mean, sorry, 80%, yeah, 90, 10, 80, 20 for A, 90, 10, 80, 20 for B, one of those strategies. Why not hire A and B? You don't have the money. You know, maybe their minimums are 100 million. And you only have 100 million, so you can't do 200 million with the two of them or whatever. Hedge funds have pretty high minimums, whatever their reasoning is. Your fund uses the concepts of parametric VAR to make such decisions. You have been asked to prepare the following presentation for the fund board. Which allocation you recommend and why. So there are words involved, okay? Don't just calculate numbers. Don't say, I recommend B, C calculations above. That's not good enough for why. You got to tell me why. So we'll talk about it. Real key for this, and the why has to do with what your boss said. What did your boss say? They wanted two things. Reduce the VAR, and very specifically, so if you have a strategy that's 83 million, but as a higher return, you say, well, no, they want it below 70 because they didn't say improve the return, did they? Maintain or improve the return. So what if one gives you an $80 million VAR, but the return goes up, and the other one gives you a 65 million, but the return stays the same? They want the latter one, all right? So you got to read the question real carefully as far as what's the better answer, because there may be an answer you think is better, but it's not in what they told you to do, all right? And then you're going to graph it. And then we'll get down here to a stochastic model. We'll talk about the stochastic here in a second, all right? So let's copy this into Excel. I'm going to do the calculations in Excel just because, and let's get the data in there. Most students, after they do a few of these, they already know what the answer is before they start. Can y'all tell what the answer is before you start? First of all, let's talk about return. What happens to return if we add A? Stays the same, right? Return's easy. Return's just the weighted average. What happens to return if we add B? Goes up. What happens to risk if we add A? It's probably going to go down. It's lower standard deviation and it's not perfectly correlated. What happens to risk if we add B? I'm not too sure, but what did I say about negative correlation? You might actually like higher risk. So what are you leaning toward now? Probably B, probably 20% B, maybe 10. We'll see. That 9% risk, you know, we'll have to just see, but you can get somewhat of a guess on this. All right. So what you want to do is set these up. So you have return, you have standard deviation, the bar. We got to figure out the number of standard deviations. So let's go back and do that. I'm looking at the problem. So what was the risk tolerance here? 0.3. So what are we looking for in the table? The risk tolerance is 0.3, so we're looking for 0.997, right? Do y'all see 0.997 right there? 2.75, that look right? Right, 2.75. All right, so let's work this out. So we've got the current portfolio. We have 10%, 20%, 10% B, 20% B. Now I wish I could take the final on an Excel spreadsheet, but we can't do that. In what year will we be able to do exams on Excel where you don't have access to the internet or notes? I don't know when that's ever going to happen. It seems like it should have happened like 10 years ago, but when y'all like to take this exam on Excel? If we could do exams on Excel, I would be giving you far more interesting questions. But that means you're going to be doing a lot of math calculations. All right, so what is the return? The return is the weight of A times the return of A plus the weight of B times return of B. It's real simple. All right, so in the current, we're 100% A. So 6% times 100%. And our standard deviation is pretty easy. It's 6%. So what is our VAR? So remember, VAR equals the mean minus the number of standard deviations times the standard deviation. So we take the mean minus the number of standard deviations times the standard deviation. Everybody good with that? Is this large enough, or do I need to zoom out some? What was our portfolio? $1 billion. We'll round down to the millions. So what's my VAR in dollars? 10.5 times portfolio. What did they say was our VAR? Has a VAR over 100 million. You feeling pretty confident at this point? Does 105 sound like a VAR over 100? Now, if you got in 362, you'd probably be okay. That's over 100, but that doesn't sound good. But you get some confidence there. All right, let's try 10% A. So if we do 6% in the current times 0.9 plus 10% times A. We already know what the answer is, but we'll do the math, just the humor. On the exam, you don't necessarily have to do that if it's that obvious. Now standard deviation. Y'all remember standard deviation? I don't want to write this out, but someone tell me. Y'all know this from memory, right? This is one formula you know from memory. It's like CAPM, duration, this formula. There's like 3 or 4 formulas you should just know off the top of your head. So someone yell it out to me real quick. Someone knows it. Come on. I'm grading your paper all weekend, so that you can be the person that I'm leaving smiling before I grade your paper.
Sum of xi minus sum of x bar squared.
That's the formula for standard deviation. I'm talking about the standard deviation of this portfolio of 2 assets.
Oh.
It's a different formula. That is correct. Don't look it up. You should know the standard deviation formula as well from memory, just like you should know beta and correlation from memory. Let me give you the start. Weight of A squared. Does that help? No? All right. Man, I'm going to have nightmares this weekend. And here by A, I mean the current. I'll use C for current. Weight of C squared plus the standard deviation of C plus the the weight of A squared times standard deviation of A squared. Anybody gonna know the rest of it? Times weight of A, I'm sorry, C times weight of A, deviation of C times A times, well, one last, someone give me the last number. There's only one last number left.
Correlation.
Correlation, thank you, Chad. Okay, correlation of C to A. And then what's the last thing we do? Take the square root of that. Yeah, if you don't know this formula, this is like, boy, I wish I kept track of how many times I calculated something in my lifetime, but this one, it's got to be in the hundreds of thousands of times. Not this formula, because I did it with, 8, 9, 10 asset classes. So then when I'll show you what happens when you have more than 2 asset classes, you just keep doing this over and over and over again, every single combination. All right, so let's set that up. So equal the weight of A squared times the standard deviation, a current. If I say A, I mean current. I'm going to lock that in because it's always going to be plus the weight of the strategy A times its standard deviation squared plus 2 times weight of A, weight of whatever C times A times that times that. Nope. Times that, right? Raise the 0.5. Does that look feasible? Did I make any math errors? I'll look at it, make sure. 0.9 times 0.9 plus 0.6, 0.06 times 0.06, that's good. Plus 0.1 times 0.1 times 0.05 times 0.05. Plus 2 times 0.9 times 0.1 times 0.06 times 0.05 plus times 0.4. Looks good to me. Does the answer look about right? Your risk does come down. That's about what you'd expect, right? It wasn't like 2% or 7.8%. There's no way risk could go up in this scenario, all right? Even with a 1 correlation, there's no way risk can go up. If your risk is lower, it has to come down. It is possible the risk to be higher and the total combined risk be lower. So the 9%, it's possible when we combine that, it can be lower because of negative correlation. All right, what's the VAR? Let's see if this works. That should still work, right? Is she gonna be happy with that? What was her goal? 70, not too good. She's like, what are you wasting my time with that? All right, let's try this one. So 0.8, I know it's a waste of time to do this, but we'll do it anyway. 0.2, 6% return. Let's see if we can copy this one over. So what do we need to change? We're going to go 80%, 20%. That's all we're changing, right? I don't need to change anything else except for type the right numbers. Any errors in there? So the risk go lower or higher? You're putting more into the lower risk asset. Seems like it has to go down, right? Even if the correlation was 1, it would have to come down. So that should keep coming down. Is the boss happy yet? Not happy. You got goal 1. Well, you did well on that one. Return didn't change. Risk did come down, but not so happy. All right, now let's do B. Now B, we will get some benefit on return. So we do pick up a little bit of return. Let's look at the risk here. That's all the same. That needs to be D, right? Y'all double check me here. That's D. That's D. All right, so it's going to come down. Is it going to come down more than 562? Do you think? You're talking about a 9% risk. Well, we don't know if it's going to come down. We're using 9%, which is a much higher number. We're using minus 0.25. So in the first part of the equation, where we do 0.9 times, 0.1 times 0.9 times standard deviation, that number is going to be higher. But the end, the 2 times the weight times the weight times the risk times minus 0.25, that's actually going to come down because the higher 9% is going to be multiplied by a negative number. So I'm going to guess it's going to be below 5%. I mean, the 5.62%. And sure enough, it is. Are we happy yet? Still not quite getting there. All right, let's try one last time. See if we can make our boss happy. That's looking good. So all we gotta do is change our percents. I could have put them in the top up there, so I didn't have to keep changing this, but not good Excel usage here. All right, did I get it? Everything looks good. See errors. That looking good. Pretty happy now. All right, so how do you answer the question? So the key on the question is to answer it the way it was given to you. So I recommend 80% current and 20% B because. All right, anybody want to try? All you do is got to repeat her own words back to you. It increases the return. It does reduce risk, but say more specifically. What does she want? Below 70 million. All right. So your boss asks for something and you come back, give them exactly what they asked. They have a specific goal in mind, so give them that specific goal back in mind. Don't say, hey, our return increased and our bar was reduced to 6.something%. They didn't ask for it in percents, they asked for it in dollars. All right, so be precise. They have a reason for asking it in that way. So put that in there. That would be a complete answer if you did all the math, right? If all of this is wrong, all the calculations are wrong, but you just happen to get a higher return and below 6, you know, it's you don't get the credit there. So you got to get the math. I don't count off for math errors unless you keep making the kind of same mistake. But so you definitely on the exam want to at least one time write out the formula and then one time put all the numbers into the formula. You don't have to do that every time. But if I can see you get at least 3 out of the 4 numbers right, and one of them you get a number that just looks wild, I probably won't count off. It depends though. There are times I think you should know, you should have some intuition that a number should be lower than another number. So I might take off a little bit for just not acknowledging that. So if you find that the case, like you get a higher number here and you're expecting it to be lower, then say, I must have a math error, this number should be lower, and then you can move on. And then if it is a math error, you won't miss in those cases. All right, so the next thing we're gonna do is we're gonna graph it. So again, on the graph, what am I looking for? Well, you go back to what they asked. So you have an x-axis. So actuary students, there's a big difference between actuary and finance. Actuaries like to put risk on the y-axis, but we're going to put risk on the x-axis. All right, I don't know why that is. Actuaries, maybe because actuaries are much more focused on risk, so they put risk on the y. We're going to put risk on the x, and we're going to put return. But the question is, what risk do we put up there? We got a few choices. We got standard deviation, we got VAR in percent, VAR in dollars. So kind of be obvious now, what do you think you're going to do? VAR in dollars, that's what they asked for. So we'll do that. When you do these graphs in Excel, you put risk first and then return. All right, so you got the current. Let's just bring it down. These are your choices. So our current has a VAR 105 and a return of 6. And so I don't know how much of this I can graph. I'm never really sure on the graphing. This is where Bill Gates really throws me off. But, no, it didn't work. So I'm just gonna do it and I'll add the labels later. So insert an XY graph. And why did Bill Gates put that on that side? Anybody know? I'm sure he had a reason for it. All right. Now, do we need all this space over here? So we can definitely get rid of some of that. That looks a lot better. It looks a little efficient frontier, doesn't it?
Yeah.
Maybe just a little bit, but we'll see. This is going the wrong direction though, isn't it? All right, so here, I just made a mistake. So anybody know what mistake I made? What did I tell you about VAR? I did this on purpose to see if you catch me. Not really, but I remember my finance boss, he was making a presentation and he put an intentional error in the presentation. And he said, I'll pay $1 to anyone who finds it.
Negative, like you have labels.
Yeah, that's it, exactly. So he said, I'll pay $1 if anyone finds it, just to get people to pay attention. And we found like 4 or 5 errors. Poor guy was out of money. So yeah, so William's exactly right. VAR, we always express it as positive numbers. So we don't do negative. All right, so now we can get rid of this. So good catch. Now it doesn't look like an efficient frontier. That's why I knew where something's wrong, because this one shouldn't. This is not a pretty typical, especially the correlations and returns. All right, so we've got our return, we got our risk. I would label these, but I'm not going to, so you should label them. So this is the current strategy right here. This is, we know this is A because it's the same return. Here's 10% B, 20% B. One other thing I would add in this is, if I can find it, insert, it won't let me do it. I can see, so I want to put a line in here, but I can't see where they're letting me.
Oh, go to format.
Well, I wanted the actual, oh, there it is. They hit it. All right. I don't know why they hit it. So I actually want a line right here. Why do I want a line right there? Because that's our kind of our goal. So a line there at the 70 million. I might want a line at the 6% as well. And Bill Gates is still not helping me here. I might want a line down here as well, but I can't get Bill Gates to help me. So where does she want you to be in this quadrant? She wants you over here somewhere. She wants you above, equal or above 6% and equal or below 70. So it becomes obvious that's the only one that meets the objectives. So when you draw the graph, the thing we're looking for in the graph, does your graph answer the question that they asked? All right. So don't give me percentages down here. Don't use standard deviation. All right. And then make it really, you do need to label the graph. I don't care about the title, but you do need to label that that's 20% B. You can just say 20% B, 10% B, 20% A, 10% A, current strategy. Becomes obvious. The rest is the current. All right. Questions on that? A lot of crunching of numbers, which I don't mind because you just made me think y'all don't know that formula. So now if you have to do it 5 times on the exam, maybe it'll stick with you. All right. So that wouldn't be bad, right? A formula you should know for your career. So there's our graph. You'll draw by hand. Put a little effort into making it look nice. I have students like, it's like I can't even tell what it is. That's just not good. You know, make it look good. So it becomes pretty obvious what you want to do. Now the question is, do you actually believe these numbers? So of these numbers, so you're doing B, of these numbers, what are you most worried about in these numbers? Expected return, how confident you are on that? How did they get that expected return? Is it based on history? Is it based on their strategy? And where did you get this number? You probably got it from hedge fund B. And how reliable is that? Oh yeah, we make 7% a year. And they do have targets. They will tell you what the target is. The first hedge fund I ordered, it was a 1% hedge fund. Their goal was to add 1% with the 1% risk. So information ratio of 1. So if they leveraged it up 20 times, it had an expected return of 20%, expected risk of 20%. Where did that 1% come from? They say that was what they're doing based on all their models. The first year we had them, they were up like 50-something%. So they didn't match the first year. And they don't say they're going to make 1% or 20% every single year because they have a standard deviation. So there's some question there. What about the risk? Most likely the risk is based on actual historical performance and some model performance. And they can do that. Model performance is not as reliable as actual performance, but that 9% is based on history more than likely. You might think about what period of time you would just go through. Was it a period of time where interest rates were falling? Maybe oil prices were rising. Maybe the VIX was rising or falling. Is that a 9% that only works in that particular environment and it might look really different somewhere else? But what number makes you the most nervous? Doesn't that one scare you the most? Where did they get that number? What did Bridgewater say about that number? Y'all remember what they said? It doesn't actually exist, right? You're going to bet your entire firm on that one number. That's probably the most important number out there. Right? What happens if the return's only 6%? You're still fine, right? Your goal was 6% or higher, so you're still good. What if the risk was 10%? That may even be better, right? What happens if the risk is 10? We can try it, right? Would it still make sense if this risk was 10%? Still works, doesn't it? What if your risk was 15%? That doesn't work. But the risk could be 12 instead of 9, and we'd still be okay. So the risk, what if the standard deviation, what the correlation was 0.1? Now it doesn't work so well. So y'all see how that correlation is you see why Bridgewater spent so much time on that one number. This is central to everything we do in finance, and we assume we know this number and have confidence in it. I spoke at a conference once. I was using a market neutral hedge fund. Or no, it was an enhanced index hedge fund. And so they asked me to speak at the conference. And so I said, fine, whatever. I don't like speaking at those kind of conferences because it's just not my field. But I said, I'll go. And so I thought I got to be humorous. And so what I did is I essentially said, all these funds come to me with their 0 negative correlations. And what I discovered, if I put enough of them together, I get this really high return with no risk. And the whole room knew I was joking. But what was I saying? We put a lot of faith in these numbers we're given as if they're absolute. But if you take it to the extreme, you can get a return with, a high return portfolio with 0 risk. If you combine, you could see that, right? We combine enough of these together, we're going to end up with almost no risk and these really great returns. And so I was kind of getting to the point that we have a lot of faith in our assumptions. So who knows where that number came from. But if these numbers are correct, if we trust B, we got it. What if A just gave us more conservative numbers because they weren't sure? Maybe their return really is 7, but they're more conservative. Who knows? What do we know about B for sure? Do they want us to invest in them or not?
Yep.
Do they have any incentives in this particular game? And what if they make 3% next year? What do they say? Hey, their standard deviation is 9%. That's well within what you'd expect. What if the market's down 20% and they're down 30%? Then you're getting a little more nervous. It's like, oh, wait a minute. But that's possible, right? There's nothing statistically says that would not be possible. But all right. So I just wanted y'all just, you should be really skeptical of correlation numbers. They're so central to everything that we do in finance. All right, any questions on that? Other than labeling the dots, this works pretty well. You may not get it this pretty if you're doing it by hand, but do work on it. So maybe bring a ruler or something to the exam so you can make it look good. All right, so let's, manager B, he's getting a business, but he's still complaining. All right, so maybe I don't like this guy, but he's complaining. He believes parametric VAR overstates his risk because he says, I have this option strategy, and this option strategy, standard deviation is not the right measure for this because it cuts off some of the risk. So it's, it doesn't have the downside tail, kind of like my put strategy I was showing you. Yeah, its standard deviation is higher. In fact, let's go, if we go back and look at that. Oh, I forgot to show you at the beginning. Let's look at this because that's essentially what he's saying. I'm gonna hide some rows here, sorry. So this is a put only strategy. So all I do is buy puts. All right. So this kind of his point that this skews the numbers. So what if someone had 100% in stocks? Their return would have been 12.12 on average. Their best year would have been 37.44. Their worst year would have been 37.02. What year would that have been? Do you guess? 2008, maybe. If you'd had a bond portfolio, you would have made 5.31%. Your best year would have been 18. Any guesses where that would have been? Maybe 2005. I mean, 1995. Right after the 94 disaster, 95 came back, 18%. Your minimum, you lost 2%. If you combine them together at 40% stocks, 60% bonds, you would have made 8%. Your best year, 26, worst year, again, 2008, because in 2008, the stocks were down dramatically. Your standard deviation would have been 7% versus 17 and 4. Here's the put strategy. Your return would have been higher than the 40-60 portfolio. Your best year would have been better. Your worst year would have been worse. And your standard deviation would have been 14.49. What this guy's saying is, I've got an option strategy that 4.49 doesn't tell you anything. And why is that? Well, because if the stock market falls 90%, you don't lose much money. You only lose 16. And what do you think is the most you can lose with that strategy? It's 16%, right? What if the bond market is also down 50%? Your standard deviation would be much higher, but your max loss, I shouldn't have done that one there. But look at this, your worst case here. Even with 60% in bonds, if the stock market, let's don't go quite that crazy. Let's say the stock market falls, let's say 50%, because it did fall 50% during 2008. Your bond portfolio, which was 90%, 60% in bonds, you still would have been down 19%. It would only been down 15% here. That was still your worst year, but you protect yourself 16. So what he's saying is, forget the standard deviation, because this one has a lower standard deviation, but it lost more money than I did in the worst case scenario. Why? Because this one's cut off at 16%. You cannot lose more than 16%. All right. So I forgot to show that to you. I don't like put strategies because they're really expensive. And there's one really major flaw to this analysis in that the downside protection is all reliant on 1 year, and that's 2008. That's the 1 year you're really, really happy you had that. Other than that, this strategy hurts your returns. You'll find that your returns always worse in this strategy, except for the 2008 that really, really helps you. So I don't like to put strategy only because it just, you're disappointed too many years. But anyway, that's what this guy's saying here is, you know what? You're using standard deviation, you're using parametric VAR. You shouldn't use standard deviation. You need to find something else. Well, what else can we do? Well, let's do some stochastic models. He shows you output from his firm's model. All right, so you're already a little skeptical. They run a 10,000 simulations, and he has some simulations below. All right, so here you got to do a little extra work. We got to look at 100% B. 100% B is going to have a standard deviation, a expected return of 7, standard deviation of 10, a bar of minus 20%, a bar of minus 205. When do we expect this minus 205? What was our risk tolerance? 0.3%, right? So which simulation are we interested in? Our bar is that 0.3 simulation. Which one is that? Right, we said 0.3, right? I think, pretty sure.
Yeah.
It is 0.3%. All right, so we ran 10,000 simulations. Our risk tolerance is 0.3. And Ryan, you know the answer right on this one. What simulation is it? Because you're about to do it in my other class. Put them on the spot. 10,000 minus. All right, I'll help you out here, but add 1. Yeah, why do we add 1? Because we're counting number 10,001. So it's, I should have asked win-win as well, right? Win-win, is this right? 9971. She's kind of, I'm stressing them out because they have an exam they have to do this on. All right, so we want simulation 9971. Do y'all see that one? So the VAR of the simulations would have been negative 14.7. And yet the parametric is saying his VAR is 205. Does he have a point? Is VAR overstating, is parametric VAR overstating his risk? Quite significantly, assuming you trust his simulations. All right, so this is a parametric which just says, hey, take your expected return 0.07 minus 2.75 times 0.1. That equals minus 0.205 or 205 VAR. The simulation runs 10,000 simulations, and you look at the 30th one from the end. That was a loss of 14.7. It gives you a bar 147. The simulation gave you a much lower, quite significantly lower bar than the parametric. Why is that? Well, because he had a skewed distribution. He had some of the tail was cut off, and so he does have a case to make. So how would you answer that? He has a point, parametric bar, parametric bar is 5 million. Well, the stochastic is only, I forget what it was. Was it 147? If the stochastic more accurate reflects symmetry distribution. Normal curve, not strategy. Something like that. I haven't spelled anything right here. Wow. Now I can't even think how to spell accurate. Does that look better? Right. So he has a point. He may not have a point. So don't assume that this guy's complaining and I'm going to say he's right. I might actually prove that he's actually is worse. Maybe his simulation comes out at negative 250 and you're like, okay, sorry to tell you, but you're wrong. And not only you're wrong, but we might not hire you now because you have, and I think I've had one question where that was the case. where you looked at the stochastic and you said, wow, that manager has a lot more risk than parametric states. Does this all make sense here in this paragraph? So what did we do stochastic? He put a lot of data in. Probably what they did, I don't know if this is stock or bond or whatever, they probably ran some indice and they has kind of a mean and standard deviation correlation and all of that. Maybe he has stocks and bonds or maybe whatever it is. But then the option goes on top of that. So he could tell with the option what was going to happen. Now, the key with an option strategy, just like we saw with the other examples, if you're going to simulate option strategies, you also have to simulate option prices. And so you got to make sure whatever you're assuming the option pricing is consistent with the environment. You can't just use a constant option price in there. And it gets tough because as markets change, your strikes change, the VIX change, everything's changing. So it's a really hard thing to simulate. But you're hoping they know what they're doing and they simulated it correctly. And you have to trust them because you can't run this yourself. You have to somewhat take their word for it. But you're going to hire them anyway. So since you're going to hire them anyway, you say, okay, well, good. So you're telling us there's a chance it might be better than what I'm saying. So, okay, I can live with that. It also could be worse than what you're saying because all these numbers are wrong, but at least you're telling me there's a chance. But so it's kind of overkill on his part. Maybe he didn't know you're going to hire him yet and he's kind of worried on the numbers. All right. Do we do this in practice? Absolutely. We do this in practice. The hedge funds I ran, this is the cap of stuff we're looking at. What do we think they can return? Are they going to be enhancing a return or not? What do we think their risk is? And most importantly, above everything else, how do we think they're going to perform? We had one hedge fund manager come in and during 2008, it might have been 2007. Remember, hedge funds blew up in 07 and then blew up again in 08. So I can't remember if it was 07 or 08. But they came in and said, every hedge fund you're using except for us is betting on VIX. You need to be aware of that. So their argument was if VIX shoots up, you're going to lose a lot of money in those hedge funds. Our hedge fund doesn't do that. And they showed us a number and they were absolutely right. Both that hedge funds did really well when VIX shot up and that their fund actually didn't do great, but it did better than the others. So that was kind of a nice input. I don't know how they knew what the other hedge funds were doing. I do know, we were talking about Credit Suisse earlier. I do know that hedge funds have this really funny strategy of hiring at least one person from each of their competitors. As I know, I was at Credit Suisse one day and some guy comes running in all excited. We finally hired the last of our competitors' employees. And so they had an employee from every one of their main competitors. And they're just kind of stealing them away. Why? Because they want to know everything their competitor is doing. So they probably did know what their competitor was doing. But then their competitors is doing what? Hiring their employees away. So it's this big game they're all playing. So anyway, all right, there's one problem. So let's look at this second one. We won't work it, but let's look at it. I'll tell you what I do. I'll put this out there on Blackboard and you can work it for next class and then we'll work it in next class. All right, but let's just look at it. An absolute return fund. What is an absolute return fund? Well, they sound great on paper. They usually have a goal of making T-bills plus. So our goal is to make T-bills plus 4%. All right, their goal is to not lose money. If you look at how they actually do, I don't think it's all that great. PIMCO has a famous one, absolute return fund. What's the ticker? PSPTX. See if I can remember that. How do you think they do? It sounds really good, doesn't it? You don't lose money. You won't make them really, really high returns, but you always do well, versus cash, which is kind of nice. What do you want to compare it to? S&P 500 maybe? So here's PIMCO, S&P. This isn't a 7% return per year. That's that. If you had $1 back here, you would have a $1.07 versus the S&P is up. How did it do when the market crashed? So that's an absolute return fund. They don't do all that well, but anyway. So it's an absolute return fund. Adding strategies over time as opportunities arise. You've been asked to find a strategy to add. You allocate 20%. leaving 80% with the current. Your portfolio is $100 million. You manage the fund to a risk tolerance of 0.2. The desire to get the firm's value at risk below 7 million without hardening expected return. Sounds very similar to the other one. Here's the strategies. You've got A, B, and C. Now, it's starting to get pretty easy which one you're going to hire. What's the one number you look at? Correlation. Absolutely. I'm not 100% that's the answer, but I'm pretty confident more than 50% that that's probably the answer. It gets back to this. Correlation is our number one tool in finance, and we rely on it heavily. But that's probably the strategy. It has the highest risk, but if the correlation is negative, that actually benefits you. Up to a point, you saw with the previous one, I could get up to 12% and I was still okay. It has higher return, but it doesn't have as much as A, but A is pretty highly correlated. All right, so very, very similar, not really that much different than the previous one. This one, we're running simulations, but only for the current strategy. So what's the question there? Your impressions as to any concerns about the consistency between parametric and stochastic VAR from the data you have accumulated on the current strategy. So you only need the current strategy here, and a brief non-quantitative rationale as to why the analysis may be inconsistent to the extent that it is. All right. What kind of words you're using there? You're talking about parametric is using normal distributions, very symmetrical. If you get differences in answers, it's because there's some skewing to the data left or right. Okay, we'll probably work a couple more of these, just get some practice. All right, so I'll put that out there on Blackboard. It should already been out there, but for some reason I forgot to put it out there. And I will give you the exam question from last year as well, so you can get one more practice problem.